This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It is my pleasure to welcome Jeff Snider to the show. I've been asking him to come on for a while, and it's good to have him here. He is the head of global research for Alhambra Investments, and you've probably seen him around or heard his name. He is a specialist in teaching people about the Eurodollar. So we're going to learn all about the Eurodollar today. And Jeff, welcome. How are you doing?
I'm great, Jason. Thanks for having me. I know we had exchanged messages, and I missed a few of those along the way, but it's great to finally be able to connect with you.
Well, we're glad to have you on, and especially since we are neighbors. You're right here in West Palm Beach, not too far from me, so it's great to have you.
Lovely Palm Beach County, right?
Yep, good stuff. So, Jeff, you talk a lot about the Eurodollar and the importance of the Eurodollar. And, maybe we can start by just having you tell the listeners, what is the Eurodollar?
Oh, boy, you're going to open the can of worms right away, right? It's a complex topic because it's really the global reserve monetary system. Even though most people have probably never heard the term Eurodollar, it actually has undertaken the functions of the global reserve currency, and it did so a very long time ago. The specific term Eurodollar, once upon a time, we're talking about back in the 1950s and early 1960s, referred to U.S. dollars that were on deposit at banks all over the world. So these were dollars that were outside the U.S. In fact, that's really what the term Eurodollar actually means. Eurodollar doesn't relate to the European common currency. It has nothing to do with the euro. Again, the term euro in the Eurodollar, the name Eurodollar simply means offshore U.S. dollar. So there's this offshore currency market. And offshore is really the key distinction here. It is not just in Europe. There's offshore U.S. dollar markets in Asia. They're in the Caribbean, across Europe. There was even a major one in Montreal, Canada at one point. So essentially, U.S. dollars floating around all over the world, doing the functions that we want the reserve currency to actually do. For merchandise trade, globalization, financial flows, the reserve currency intermediates between various different systems so they can all work together in essentially a seamless fashion. Now, the real quirk here, in addition to being offshore, is that these aren't actually physical U.S. dollars. These are not physical Federal Reserve notes. There's no $100 bills floating around outside the United States in this vast multi-trillion-dollar space. Instead, this is what's called ledger money or money of account, where banks trade assets and liabilities back and forth based upon various financial or merchandise or global payment needs. And therefore, it's a system of keeping track of who owes what, where, in terms of the digital currency revolution we're currently experiencing, it's a distributed ledger, except the distributed ledger is maintained by these large global banks that operate all over the world. So essentially, offshore ledger money, U.S. dollar denominated, but not really U.S. dollars, and it's run by the banking system, the global banking system.
Okay, so the vast majority of our audience, of course, knows that the U.S. dollar is the world's reserve currency, but you call this a slightly different name, a reserve currency system, right? Is that what you said?
Yeah. And it's the U.S. dollar denomination. That's what we use here. And it's sort of disingenuous because, again, this is not U.S. dollars. This is not Federal Reserve notes. This is not Treasury currency. It's ledger money that's denominated in U.S. dollars, but it's what's called a fictional currency or an ideal currency or ghost money, as it's typically been called in the past.
And some would call the way the whole system works all of those things, but we won't go down that rabbit hole. But yeah, I see what you mean. So basically, it's people and really companies, financial institutions, keeping an accounting system denominated in dollars, but there's no dollars.
Yeah, it's not convertible. It's reserveless. It's not like you have a U.S. dollar liability or a U.S. dollar asset with, say, a bank in the Cayman Islands. If you're another bank somewhere along the system, theoretically, you could convert into physical Federal Reserve notes because that's really what we're trading here. But nobody ever does that because physical Federal Reserve notes are physical currency, let alone gold bullion or something like that. Those are they're very cumbersome to use. They're expensive and they don't settle right away. And so part of the Eurodollar story is a technological and communications revolution that developed over the last half of the 20th century. So if you're in Asia somewhere and you want to import goods from, say, Europe, do you really want to wait for physical U.S. dollars to transit the entire globe? Even if you could put the currency on an airplane, it still takes some time, and you have to arrange for the settlement to take place in physical space, where it's much easier to just pick up the phone and say, hey, I owe you $100 million. It's on deposit. It's a book entry at a bank near you. Or better yet, I'll just send you a telex message. So we can develop essentially a communication system that creates all of these book entries so we don't actually have to settle in physical cash. We can just settle when your receiving bank says, yes, I got the message from the sending bank in Europe. We're all set. I credited your account, whatever you need, and you can use it however you want. And we can do things at the pace of a modern globalized economy. So without having physical currency, we can use, fax machines and telexes and eventually the internet and electronic communication as a much quicker way to settle financial flows or merchandise flows.
Okay, so why does the Eurodollar matter? In your teachings, it's a huge deal, right? Why does it matter? And, some people might be surprised that it's so significant when many people haven't even heard of it.
Yeah, that starts from the very beginning because the Eurodollar sort of developed on its own. There was no government effort. There was no even individual private effort that said, let's build an entire currency system, entire virtual currency system in the 1950s and do it outside of every country's regulatory regime. It just kind of happened. And so because it kind of happened and because it was solving a very real, very big problem, the inherent flaw in Bretton Woods called Triffin's paradox, governments were content to just say, let's keep our hands off of this thing. It's called benign neglect. Let this thing develop because it's creating an elegant solution to what was a very big problem at the time, which was the gold reserves or gold exchange standard in Bretton Woods was not suitable for a globalized economy that required a dynamic money marketplace to match the demand for money with the supply of money. And so that's really what the Eurodollar did. And it did it in these shadows so that, practically nobody heard about it. And because it was doing these, undertaking these roles of the reserve currency system, it had to be pretty substantial. It had to be enormous. And eventually over time, it grew to be bigger than the U.S. domestic currency system. And we don't really know when that happened, probably sometime in the 70s and 80s. But for a very long time, this Eurodollar system is an order of magnitude larger, more important, more substantial than the domestic U.S. dollar credit and money system. So in order to undertake the roles of a global reserve currency, it had to grow quantitatively as well as qualitatively, all of it outside the United States. So we've heard about the Federal Reserve. We're taught the Federal Reserve is the central of everything. But the Federal Reserve, even if you consider it a central bank, its regulatory authority stops at the U.S. border. So if we have this monetary system, this global reserve currency system, even though it's denominated in U.S. dollars, it is outside the jurisdiction of the Federal Reserve, which is one of the primary reasons you've never heard about it. We have this global U.S. dollar system that operates in these vast blank spaces outside the United States.
Sure. And Jeff, you've got a chart of interest rates on the screen. Now, some people will be listening on audio only, so let's make sure we verbalize things here. But what is this showing us? Is this showing us the influence of the Eurodollar?
Absolutely. And, I think most people are taught, and I know if you have any exposure to economics in college and then afterwards through the financial media, that the Federal Reserve is at the center of everything. And the name is a central bank for a reason. But there, and so we believe that the Federal Reserve, as this all-powerful, omniscient central bank, is the ultimate setter of interest rates, including mortgage rates, which is, I assume, very important, very topical for your audience, Jason, and for what you do, right? I mean, mortgage rates are absolutely important, absolutely crucial to the real estate market. And yet, this myth persists that when the Fed raises rates, for example, that it's going to be raising rates on mortgages too. And the reason that myth persists is because of what we've been taught about the Fed as this omniscient central bank that prints money if it has to. It does open market operations. It sets interest rates all across the curve. When in fact, that's not what happens in the interest rate market at all, whether it be mortgage rates or other rates. And it's because the Fed doesn't actually do much as far as money. It may create bank reserves in programs like quantitative easing, but that's not the same. The Eurodollar system is the monetary system. And by and large, what happens is that you can see that it's the Treasury market that actually sets most credit rates around the world. And even something like 3-month LIBOR, which is short-term money rate, is set by something called Eurodollar futures and Eurodollar market in London. So the Fed doesn't actually control interest rates because the Eurodollar system is the money in the entire global credit system and therefore the global economy. And treasuries are the basis of it all. And treasury prices and yields are reflective of those monetary conditions in the Eurodollar system, not the Federal Reserve, not what the Fed's doing, in the Eurodollar system most of all. And then the implications, whether that leads to growth and inflation or deflation. If we have problems in the Eurodollar system, that's going to be reflected in treasury yields. Therefore, it's going to be reflected in things like mortgage rates. So it's the treasury yield that sets the basis for all the interest rates that come after it.
Okay, great. And so what is the chart showing us exactly? Just unpack this a little bit for us. The black line is the 30-year mortgage rate, right?
Yeah, that's the average American 30-year domestic 30-year mortgage rate. I mean, it's going to vary in different parts of the country, but by and large, that's a pretty representative benchmark for what's going on in the mortgage market. Okay. The gray shaded area is the Fed. That's before 2008, the Fed had a single target for the federal funds rate, which is how it communicated what it was doing to the public. So, for example, in 2004, Alan Greenspan at the Fed said, I think the economy is doing really well, maybe in danger of becoming so well, we need to tighten things up. And everybody associates higher interest rates with tightening. So the Fed began a campaign of raising the federal funds target rate 17 times a quarter point every time, so that by 2006, the federal funds target had gone from a low 1% to upwards of 5.25%. And so we're taught to believe that the Fed hiked rates that much in that couple year period of time that the mortgage rates and all interest rates probably should have gone along with it. But as you can see clearly on the chart here, and for people listening, I'll describe how they didn't at all. And in February of 2005, Alan Greenspan got in front of Congress and called this a conundrum. He said, hey, we're raising rates, but the mortgage rates were not rising all that much. They did a little bit, but not nearly as much as the Fed was hiking rates because the Treasury market didn't raise long-term bond yields anywhere close to the amount of the Fed's rate hikes. So we have two different things going on here. The Treasury market is reflecting something else, while the Federal Reserve under Alan Greenspan said, we're fearful of inflation, we need to hike rates. Those did not get transmitted into the Treasury market. Therefore, they didn't get transmitted into the mortgage market or any other parts of the credit system either.
Okay, so what should people be watching to try and understand what's going to happen next?
Well, here's the thing. We have to unpack what is it that Treasury yields are reflecting? What is it they're trading on? Because again, it's the risk-free rate upon which all the credit markets build up. We start with Treasury yields and we build spreads off of those because that's really how finance works on a nitty-gritty granular level. So it makes sense that we should understand what's going on in Treasury markets, that maybe, whether or not it's agreeing with the Fed or disagreeing with the Fed, what is it that Treasury yields are actually telling us? And if you go back to Irving Fisher in the early 20th century, he said, and his history has validated repeatedly, long-term Treasury yields from the middle of the curve on out are always some kind of combination between growth and inflation expectations. Set aside the Fed, set aside the financial media. A Treasury yield is a market reflection of growth and inflation expectations over the intermediate and longer run. And remember, the Treasury market isn't just, some niche market. It's the biggest, deepest, most sophisticated market in the world. And more than that, the participants in that market who are trading U.S. Treasuries, who are making these yields come out, they're the same banks that keep the ledger in the Eurodollar system. So even though we can't directly observe what's going on in the monetary system because it's offshore, because officially nobody's ever kept track of it, we have a decent idea of what's going on anyway, because we can look at something like the yield curve, the Treasury curve, or other various money curves that tell us what the participants in the money markets, in the shadow money markets globally, are actually thinking. What are the risks they perceiving? Are they thinking inflation? If they're thinking inflation, what we would expect to see is that long-term bond yields would rise and rise rapidly. Again, Irving Fisher said, if you're fearful of inflation, the last thing you want is to hold a safe and liquid asset. You're going to sell that thing and go after nominal opportunities elsewhere. If long-term treasury yields are not rising, that presents the opposite sort of set of circumstances where it looks like the monetary system itself is willing to demand and hold safe and liquid assets. So what does that tell us if safe and liquid assets are in high demand, regardless of what the Federal Reserve is doing? It tells us something very specific about inflation and growth, and none of it is very good. So putting this in terms of the middle 2000s, Alan Greenspan's conundrum, he said the economy is doing really well, growth and inflation are going to be good, maybe even too good. I need to start hiking the short-term interest rates to tap on the brakes a little bit. The Treasury market said, we don't agree with you, Alan. We don't think that inflation's a problem. In fact, we're really fearful of this whole housing bubble credit thing. It might blow up and lead to deflationary circumstances at some point down the road. So Greenspan did one thing. The Treasury market, reflecting what was going on excessively in the Eurodollar system, did another thing. And as it turned out, short-term rates collided with long-term rates in what's called the yield curve inversion, which I'm sure people have probably heard a lot about. When short-term rates reach long-term rates and they go upside down, it's usually a recession signal for these reasons that I'm laying out now. It's the market saying we disagree with what's going on the short end of the curve, which is influenced by the Fed. Instead, we're more fearful about low growth, low inflation, maybe even disinflation and deflation, and that's what keeps bond yields low, and that's what eventually leads to a flattening and then inverted yield curve. So in the middle 2000s, the Treasury market got it right. Alan Greenspan got it wrong. The Treasury market was fearful of the housing bubble coming apart, which obviously it did, and eventually that led to the global financial crisis and Great Recession.
Yeah, so I'm curious, you've got me curious about, and maybe you know, and maybe you have this off the top of your head, but what year did Alan Greenspan make the famous statement, irrational exuberance? Was it before or after that? I'd be curious.
I am so glad you brought that up, because that goes into the Eurodollar story too, believe it or not. That was December of 1996. He made his
wow, it was much earlier. Okay.
Yeah, people remember it. People our age obviously remember it because of the .com bubble, stock bubble, and people were
and Schiller wrote a book on it too, or two books.
Yeah, and they got it all wrong. That's not what Alan Greenspan was referring to at all. He was referring to the Eurodollar, not specifically, but what Alan Greenspan was saying in December of 1996 was money supply trends had veered off path years ago. That's an exact quote. What he meant was just what I said at the outset. The monetary system had evolved into this Eurodollar system, which meant all of these traditional monetary definitions and statistics like M1, M2, and M3, those had been obsolete for decades. So by the early 1970s, M1 and M2 they were no longer reliable. And so what he was saying in 1996 was, we don't keep track of money. We can't keep track of money. So how would we know if the stock market is behaving rationally or irrationally? That's what he was actually saying. We don't do money. We can't. It's too complicated. It's offshore. It's in the shadows. So we don't know if asset markets are actually behaving rationally or irrationally. And
that is very interesting.
So you put that in the middle 2000s context, Jason. It's the same thing. How do we know if the credit bubble is behaving rationally or irrationally? Well, let's look at Treasury yields. They are a perfect signal that something was not right. Alan Greenspan and Ben Bernanke and all those people were, hey, there's no, housing never goes wrong. Don't worry about it. When the Treasury market was very clearly worried about something, which is why growth and inflation expectations, therefore low bond yields, intersected with short-term rates and created a flat and then inverted curve.
So do you agree with his statement about M1 and M2 being unreliable? And then I want to ask you about M3 and, getting rid of that. But what do you think about that?
Oh, yeah. M1 and M2 were basically, M1 became obsolete way back in the 1960s. And M2 There was an original M2 that wasn't as comprehensive. It sort of evolved. But even then, M2 was probably obsolete by the 1970s. And for reasons of Eurodollar, there's things like repo, there's things like money market funds that developed, this ledger system offshore, all these things. And so the Fed and economists started moving toward an M3, which they tried to incorporate. You think about what's an M3, it's not an M2. That's things like institutional money market funds. It's things like Eurodollar deposits. It's things like repo, that they could never actually capture the full broad range of those things. So by 2005, 2006, the Fed said,
they yanked it.
We give up. It's not because they were trying to hide monetary growth.
Because that was the theory. A lot of people were very upset about that. They thought, oh, this is just a big scam. They're covering up. They don't want us to know the money supply. And
they were actually being honest, Jason. That's the weird thing about it.
That's amazing.
Once in his life was saying, we can't keep track of money. And it goes back to what Greenspan said in 96. We have so much trouble keeping track of money. Why bother even trying? So what they said in 2005 was, we can't keep track of this stuff, so we're not even going to spend $1 million to keep the numbers going, which I think was the mistake. The mistake wasn't that they were covering something up. The mistake was they should have said, we really need to do a better job keeping track of money, even though it's going to be incredibly difficult and nobody's been able to do it for decades. We should have taken M3 and developed it further rather than just giving up on it. Yeah, and the reason they gave up on it was because of this rate hike nonsense. They really believed that if Alan Greenspan or Ben Bernanke got on TV and said, I'm hiking rates, everybody would just assume that was tightening in the monetary system and they would act that way, when they really had no idea if that was the case.
Very interesting. So, Jeff, I want to make sure we cover, because we could talk for a day or two on this, of course. And, it was good when you and George and I had lunch and I listened to you guys really going back and forth about this stuff. But what is your prediction about where we're going in terms of interest rates, equities market? I mean, are they just going to keep pumping this bubble up? If you listen to Harry Dent, who's been on my show 11 times now, over probably 11 years, he's just been saying the bubble's going to pop forever, and it just keeps inflating.
Right.
It's like that, and that's one of the problems I find with a lot of the economists out there and the gurus. What they're saying makes sense, right? Everybody's astonished at the math. Over $30 trillion now, in terms of obligations and all these unfunded mandates, and they're just going to print, and the bubble can't go forever. But the thing is, nobody knows how far it can go.
Well, let me back up first, Jason, because the Eurodollar story, it means that the Fed does not print. The Fed creates bank reserves, which are not a form of useful money in this context, which is the reason why before last year, all these claims the dollar was going to go to zero, that inflation was going to get out of control, never happened. When you heard that from the very first quantitative...
Clearly, we're not talking to Peter Schiff.
Yeah, exactly. So why didn't that happen? And look at the yield curve. The chart we're still showing you here explains everything for you. It tells you that no money was actually printed because, contrary to popular perception, low interest rates are a sign of tight money, not loose money. Let me repeat that. Low interest rates historically everywhere, not just in one case or another, not just in one time period, but everywhere. Low bond yields are a defined prohibitive signal that money has been tight and continues to be tight. Again, think about why that is. Growth and inflation expectations and long-term yields. And historically, during the Great Depression, what did interest rates do during the 1930s? People probably don't realize they went low and went lower and lower and lower, not higher. They went lower because safety and liquidity was in demand during the deflationary 1930s, just like the deflationary 1990s in Japan. On the flip side, the 1970s, the great inflation. What happened to bond yields during the great inflation? They went up. They skyrocketed. They got up into the double digits. So what we're taught about interest rates is completely backwards. And Milton Friedman called this the interest rate fallacy, which I think is a perfect title for it because we believe the wrong thing. So we look at this chart here, and you can see 2008 very clearly where bond yields and mortgage rates fell. That wasn't because the Fed reduced interest rates or that it engaged in quantitative easing. It didn't print money, and the bond market, the Treasury yields are telling you the Fed is creating bank reserves, which is not the same thing as printing money. So that's why we had this inflationary period for almost a decade that nobody could explain. The dollar only got stronger because there was lack of dollars in the Eurodollar system. Bond yields fell. We never saw the Treasury market blow up like it was supposed to, because the demand for safety and liquidity was always there. And you look at 2017 and 2018, you can see the Fed engaged in interest rate hikes then too, because they thought in 2017 and 2018, the global economy had strengthened and that the U.S. unemployment rate had declined substantially, so that inflation was going to arrive by 2019. And you could see how, again, in 2017 and 2018, the bond market said, nope, disagree with you. Bond yields stayed low. The Fed hiked rates. The yield curve flattened and then eventually inverted. And guess what happened in 2019? The Fed ended up cutting rates, not raising rates. There was no inflation. There was none of that. So the idea that the Fed has printed a bunch of money and that explains everything, the biggest market in the world is disagreeing with that, and has the entire QE period in the United States.
I mean, Jeff, how do you go to a cocktail party with a bunch of economists? This flies in the face of what we've been taught, right?
I say, just look at the charts. What I say is you don't have to take my word for it. Again, Alan Greenspan, 1996, he admitted the truth there. And that wasn't the only time. There were several famous speeches throughout the 1990s and early 2000s where Greenspan basically said, we don't do money. We don't know how. And then if you do any kind of historical research,
but admit it, you have to admit, though, Greenspan talked in hieroglyphics, right?
No, I'm talking the private conversations. You look at, say, the FOMC transcripts where he didn't talk in Fed speak. He actually talked openly. There's a famous quote from June of 2000 where he said, basically, what he called the proliferation of financial products was so extreme, we can't base monetary policy on money because we can't find it. We don't even know what it is.
Well, there's something to be said for that. I mean, I agree. Yeah.
But what does the Fed have to do that? But the Fed, all it has is bank reserves. It doesn't. It can't engage in currency swaps with private counterparties, which is more aligned with what the actual Eurodollar does. It can't engage in securities lending, although it does to a certain extent. It doesn't do all of the things that the Eurodollar system had developed over the decades, so that when everything went wrong in 2008, the Fed was sort of a bystander. All it could do was say, we'll increase the level of bank reserves and hope that's enough, but that's why it didn't work. That's why we had the financial crisis to begin with. And so after the financial crisis, during the quantitative easing period, the Fed just kept creating more and more bank reserves because bank reserves aren't money and they weren't fixing the problem. And again, you don't take my word for it. It's right there on the screen on the chart of bond yields. Low bond yields are the definitive sign of tight money, which brings us to 2022. The difference is obviously that consumer prices have accelerated dramatically over the last year, but yet bond yields have only risen a little tiny bit, especially in the historical context. So we're already sort of getting conflicting signals here, especially as over the coming weeks, it's less than a month now, the Fed is expected to start hiking interest rates again, at least not hiking its interest rates again. The bond market is saying, the Fed is going to hike interest rates, but it's not the same thing as, say, raising rates.
Interesting. So where are we going? What is next? What do you predict? That's what we are all dying to know. Based on this ideology, which flies in the face of a lot of what we hear out there, or the vast majority of what we hear.
It contradicts everything you've been taught from the beginning. It's absolutely, it's unorthodox as it gets, but again, it's the evidence is right there. So what does that mean for the rest of 2022 going forward?
Yeah.
Well, one thing we can tell from the yield curve and other markets too, things like Eurodollar futures, there's a tremendous amount of skepticism as to why the Fed is hiking rates. Now, why is the Fed hiking rates? Obviously, consumer prices, but Jay Powell said
cool in an attempt to cool the economy.
Yeah, but he said last year that the inflation was transitory because it wasn't inflation; it was a supply shock, and he was right about that. That's what the bond market is actually pricing. So he changed his tune late last year, not because of that, but because he thought, well, we're not really a central bank. We don't do money. So we do this expectations-based policy where we move short-term rates around and try to influence behavior. So briefly, economic theory holds that if consumers start to get acclimatized or normalized to high rates of CPI for whatever reason, that will feed into inflationary pressures. Even though there's no evidence for this, this is one of the things that drives central bank theory. And the other thing is the unemployment rate, tight labor markets, the idea that there's competition for workers that'll drive up wages, therefore that'll drive up consumer prices, the Phillips curve. Even though it's been shown over especially the last decade where the U.S. unemployment rate in particular doesn't capture the participation problem, therefore it's not necessarily a very good judge of inflation pressures through the Phillips curve either. So Jay Powell said the unemployment rate's falling in 2021 into 2022. It's down to around 4% now. We have this danger of inflation expectations, which there's no evidence that actually plays any role. So they're hiking rates, as you just said, Jason. They think they need to tap the brakes on the economy to get inflation under control. In the bond market, the yield curve, as in 2017 and 18, as in 2005 and 2006, the yield curve has flattened dramatically. It hasn't inverted, though it almost inverted just a week ago. While the Eurodollar futures curve, which is a snapshot of 3-month LIBOR in the future, which we don't need to talk about here, the Eurodollar futures curve is inverted, and the inversion grew dramatically over the past week or so. What these markets are saying is they disagree, again, with the reasons why the Fed is raising rates. The market does not believe that consumer prices are being driven by legitimate inflation. They're being driven by temporary supply shock factors that are already starting to wane. Even though we didn't see it in the U.S. Consumer Price Index recently, pressures around the rest of the world have already shown themselves to start. They're starting to come down. And so the markets are betting.
So you're saying that
wrong.
So you're saying that as far as consumer prices are concerned, you do agree that inflation is transitory, right?
Yeah, I don't think it's inflation, people think
it's supply-demand shock.
Yes, people are thinking I'm making a semantic argument when I'm not. Right. I'm making a categorical argument because, as Milton Friedman said a long time ago, inflation is always and everywhere a monetary phenomenon. So if you don't have the money, you don't have the inflation. And as you can see in the yield curve, there is no money. There is no money printing. We had a supply shock, which is a temporary deviation from, inelastic supply, given a rightward shift in the demand curve, leads to prices going up. But those always adjust over time. Given enough time, we'd expect consumer prices to settle down. And that's what the market is pricing right now. We're starting to see the settling down part of the transitory supply shock. It's not money printing. It's not inflation. And the market is betting it's not going to stick around very long, and that the Fed is wrong about why it's raising rates.
Wow, interesting stuff. So what can we expect, for example, for this massively overheated real estate market? This may sound odd as a real estate guy, but I'd love to see it cool off a bit. Not too much, but a bit. It's just very hard to operate in a market like this. I mean, there's so much demand, Jeff, and the construction materials costs are just skyrocketing. I was reading an article this morning about steel prices up 110%. It's incredible.
Yeah.
How does that look?
Too, right? I mean, it's
everything.
And again, that's the supply shock from the COVID recession. It's not money printing, although there is an element of psychology to it, especially in the real estate market. And I think I echo your sentiment too. Is you'd like to see the real estate market cool off, not crash, right? We want it to come back down to revert to more of a legit or more of a
balanced market.
Yeah, something like where it's not just ridiculously overheated. And I think that's really kind of what the market, the Treasury market, the money markets are actually saying, is that the macro implications of transitory consumer prices actually could be beneficial in something like real estate construction, because if commodity prices eventually come down where supply and demand factors start to more balance out than they've been able to over the last year, that could help. But the downside case to that is that if the macroeconomy part of this is, if the low growth and inflation expectations and low bond yields are correct, then we have a generalized global economic slowdown that's coming, the Fed is hiking into, that's coming either this year or next year, probably later this year than later next year. So yeah, maybe lower commodity prices, disinflation in general terms, but at the same time, the downside to that is lower economic growth for a global economy that hasn't really recovered from the 2020 recession.
Yeah. Wow. Okay. So a little more than that in terms of how it looks, just give us any more thoughts in terms of mortgage rates.
That might be the good news.
Prices. Yeah, right.
The good news, again, because the Treasury market, not the Fed, sets mortgage rates. The flattening of the yield curve says the Treasury market is resisting higher rates, which means mortgage rates should resist the Federal Reserve's impulses too. That doesn't mean they're not going to rise. Just like bond yields are up this year, and they've been up since August of 2020 by about a point and a half at the long end. So they have risen somewhat, but it's not going to be like the Fed is going to raise rates to 8% and mortgage rates are going to go double digits over the next 18 months or so. The bond market is saying there's no chance of that happening. If mortgage rates rise any further than they have over the last couple of weeks, it's not likely to go much further than they are now. And then we get into curve inversions and flattening and things like that, where it may be that the market starts to bet that rates actually start to decline at some point, given the macro implications of a weaker global economy, no inflation, transitory consumer prices, transitory commodity prices coming back down. So it may be that we get a little bit of a rise in mortgage rates, but then they trend back lower at the end of this year into next year, maybe next year or whatever. So the market is saying there's a ceiling on credit rates as well as a downside potential building in them at some point in the future.
In the classical thinking, not your thinking, but in the classical thinking, I just don't know that the Fed could raise rates very much. It just seems like there are too many tender spots in the economy. Now, granted, of course, it feels like it's just on fire right now, but underneath the hood, it's really kind of a different story, isn't it?
Yeah, and that's the money illusion that consumer prices have created this illusion of a red hot economy when in fact you look at all the volume statistics. I'm not talking about real estate specifically, but volume statistics in the actual economy, whether it's industrial production or global trade, the volumes of trade, we're still significantly less than 2019 and 2018. We haven't rebounded to a new global high yet. And that's been masked by what's happening in consumer prices, which have created this illusion that the economy's on fire. The Fed needs to step in. And asset markets like real estate, as well as stocks and digital currencies and crypto, things like that, have only reinforced and fed into that perception that everything must be on fire and the Fed has printed way too much money and all these other things, when the deep fundamental markets like the bond market are saying, it's not happening. We didn't really recover. We had a bout of consumer prices that were for other reasons. And now we're starting to see the real global economic state start to materialize after we get through this artificial influence of 2021. So, classical economists, you're right. There's this idea. It sounds just like a macroeconomist talking about something they call R star, which says interest rates are low because the economy is just awful. But even if you take that at face value, what does that say about the economic and growth potential even going forward under those terms?
I mean, just simply looking at it, though, at the real estate market, if rates stay anywhere near this low, it just seems like it's just going to keep going crazy. I mean, there's just no supply.
Yeah, and I think that speaks to the macro weakness, right? Because the real estate market isn't like the middle 2000s market, where everybody was in real estate. Everybody was the low end, the high end, the middle tiers, everybody was succeeding. This is a bifurcated market where those at the low end that are struggling because the economy hasn't really recovered, they're not participating, as you just said. Yeah. They're not selling their houses. They're not moving up because they can't. Yeah. So supply is restricted. And in one sense, we're seeing the same phenomenon in real estate that we saw in the real economy last year, where it was a supply-demand imbalance for artificial reasons. And a lot of it has to do, too, with people who are buying up real estate because they think they have to. They think they have to protect themselves against inflation because the Fed printed, the money printer go burr, all of that stuff. And so there's this psychology that goes into real estate as well as the stock market. The stock market is probably even a better example of how you have to protect yourself from the Fed when the real economy, where real estate actually is more exposed to real factors. You see this bifurcation, this bottleneck where a whole lot of demand is being shoved into a smaller part of a smaller cross section of the entire overall whole, simply because there's this illusion that the economy is red hot and on fire, when there's this whole big part of it that actually isn't, that actually is really legitimately hurting.
And when you say that, you're referring to, at least to a large extent, the wealth gap, right?
Yes.
Yeah, yeah, and I couldn't agree more. And that's the problem with this dysfunctional situation we've got. And I think it is toxic. It really just transfers wealth to the top. Call it Cantillon effect, whatever. A lot of people just don't get to play the game, and if you can't play the game, then you're just left behind. And it's so unfair. It's so sad. It really is.
Yeah, and the biggest problem is the last decade, the economy has never, we talked about earlier, the participation problem. Think about what that means. It means a lot of Americans, and it's not just an American problem, it's a global problem.
All over, yeah.
Yeah, a lot of Americans, a lot of workers were put out of work, a long time ago, and they never went back. And so It's not even, you can't even get in the asset markets. You don't even have a job. You're depending upon, unemployment or disability insurance, your government, some kind of government program.
I mean, the only good news is some of those have started their own business, they freelance, et cetera. But yeah,
there's definitely the gig economy. But even that, there's a debate and argument about whether or not that's a close substitute for a traditional job type, because there's not a lot of security in the gig economy. Maybe there's some upside there, but are people participating in the gig economy by necessity or because there's opportunity there? Right. And I think the answer is, again, the participation problem, where the economy doesn't work. It hasn't worked in over a decade. And so people at the bottom, those who aren't working, and those maybe who are, but they're not getting paid what they maybe should be getting paid, they get left behind, and they have to watch other people get rich on, real estate speculation or Dogecoin or something like that. And they think, the Fed printed money, let's burn everything down. Let's start all over again. When the real issue is right there in front of you, the bond market is telling you what's been wrong since 2008. We have a tight monetary situation that has led to deglobalization, lack of economic growth globally that nobody has any answers for.
So with your methodology, and maybe this will be the last kind of point we cover because I know we got to wrap it up, but with your methodology, Jeff, how far into the future can you see? Is this something that's a really more of an immediate thing where you can look at, hey, what's going to happen the rest of the year? Or can you look out 5-10 years with, when you get your head around the Eurodollar and just the way you see things, your worldview?
Yeah, be careful. Nobody has a crystal ball, so we're not making predictions, right? Yeah. And the other thing is you can't look at the bond yields or you can't look at Eurodollar futures and take them literally either. So what bond yields or Eurodollar futures, what these curves are telling us are probability distributions, and they're probability distributions that have arisen based on their participation. These large banks that create money or destroy money, the actual Eurodollar system, what are their perceptions? What are the probabilities that are being bet in these markets? And you can get a sense of maybe a better sense of the long run, because the short run's dynamic and it's hard to pin down. But starting with the intermediate and longer term, when you see bond yields being low, you see Eurodollar futures curves flatten out as low as they have. That's not a very good commentary on the long run forward. And what they're actually saying right now, even after yields have risen over the last 6 months or so, they're saying that the 2020s might be even worse as far as global economic potential is concerned than it had been in the 2010s. So if you want to start out with a very depressing and pessimistic viewpoint of the coming decade, that's what the bond market and the money markets are telling us, that nothing has changed positively since March of 2020. And in fact, there's a very good likelihood that we went into this COVID overreaction recession in 2020 that actually did a lot of long run economic harm, which actually makes intuitive sense because you don't just shut down the economy and expect to come out of it scot-free. Right. So the bond market's saying long run potential is not really great. In the short run, you can make some judgments based on the shape of the curve. For example, I mentioned inversion. I mentioned the yield curve flattening, which is depending on the level of flatness in each of these curves, or the inversion and the other one, that can give you a sense of some more immediate concerns or immediate danger potential. So you can use the curves to give yourself some sense of what might happen in the short run too.
Yeah, good to know. Well, Jeff, it's great talking to you. I just wanted to share one thing. I sent this to Ken and George yesterday, and I was walking by a restaurant near my house, and this sign, just speaking of this sort of dysfunctional situation we have and how all of the powers that be create all sorts of unusual hardships for people, right? A sign in a restaurant window, it said, "We are very short-staffed. Thank you for your patience. If you're out of patience, please ask for a job application.
Nice.
Yes. You know, all of this stuff makes it hard to get workers. It's very imbalanced right now, isn't it?
And it's only getting worse, right? I mean, our perception of how things are actually do match these low bond yields that are saying, despite everything that happened last year, you know, potential is really not that all, you know, it's really not there even going forward.
Yeah, really amazing. Give out your website or whatever contact you want to share, Twitter, whatever. I
post a lot of research focused on the Eurodollar system, as well as the implications, the macro implications of what's going on in the monetary system, how to read these curves and interpret these various very important signals. At my company's blog, it's Alhambra Investments. The website is alhambrapartners.com. I also have a podcast with my co-host Emil Kalinowski. It's called Eurodollar University. Again, we go into detail about the monetary history, the inner workings of the system, as well as interpreting what all these various markets are telling you about how things are going in the money, how things are going in the economy, and what to do about them.
Good stuff. Jeff Snider, thank you so much for joining us.
Thank you for having me, Jason. I'm glad we got a chance to finally get together and talk about these things.
Me too. It was really enjoyable. Thank you.
All right. Take care.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.